Harry's Capital just released its second quarter 2026 earnings results, and for high-yield dividend investors, this quarter brings up a classic question. Is that 10% yield fully protected? After the market closed on July 29th, the largest BDC in the market reported core EPS of 47 cents per share, coming in right in line with consensus estimates. Total investment income hit $768 million, up year over year, but slightly light against analyst forecasts. Meanwhile, management declared its third quarter dividend at 48 cents per share. At first glance, seeing core EPS at 47 cents and a dividend at 48 cents might cause a double take, a 1-cent gap. But as seasoned BDC investors know, looking at a single quarter's core earnings never tells the full picture. Here is why that 1-cent difference isn't a red flag for Ares Capital. The company is sitting on a massive tax spillover income buffer. Management confirmed that ARCC holds approximately $988 million in estimated taxable spillover income from prior gains. That equals roughly $1.38 per share in undistributed earnings carried forward on the balance sheet. In plain terms, even if market conditions soften or interest rate cuts reduce net interest margins slightly down the road, Ares Capital has nearly 3 full quarters worth of dividends stored away purely as a safety net. That structural advantage is precisely why ARCC has maintained 17 years of stable or growing regular quarterly payouts. While the income side remains robust, the balance sheet did experience mild compression this quarter. Net asset value, or NAV, per share landed at $19.35, down from $19.59 in Q1. That decline was primarily driven by unrealized portfolio valuation adjustments rather than actual realized defaults. Looking under the hood at portfolio health, credit quality remains strong across their 619 portfolio companies. Non-accruals remain well controlled, and about 75% of new transaction activity this quarter came from existing portfolio incumbents, showing that ARCC is leaning heavily into top-tier borrowers they already know well. From a balance sheet perspective, Ares Capital continues to set the benchmark for liquidity and access to capital. During the quarter, the firm completed the repayment of $1 billion in unsecured notes, while establishing the BDC industry's first commercial paper program to lower borrowing costs. Even after these debt maneuvers, ARCC holds approximately $6 billion in total available liquidity, with net leverage holding steady at a comfortable 1.12 times debt to equity. This gives management tremendous dry powder to opportunistically fund new, high-yielding direct loans as market deal volume picks back up. Finally, for full transparency, let's look at my own numbers in Ares Capital, using the screenshots I just took on August 6th. I've held ARCC since February 26, 2026. My current position value sits at $5,269.44, built from $5,030.68 in total net cash flow I've invested. My total gain on this position is $445.03. Now, if you look at the price action alone, my pure market gain is $238.76. But as a true income investment, the cash flow has been key. I've already collected $206.27 in total dividends in just over 5 months. That brings my money-weighted return to a solid plus 12.45% since I started the position. This is the exact example of why I hold ARCC. The combination of stable price performance and high-yield dividend cash flow is delivering exactly as expected. As always, this video is for informational purposes only and is not financial advice.